guys, so now we are back. We are going to continue with what we have done previously. Previously, we did chapter 7. We spoke about ROCE and also payback period. And I also did mention to you that when you are doing your payback period calculation, what is very important for you to note is that payback period as compared to your ROCE, it uses cash flows rather than profit. So for the purpose of understanding more detail about cash flow, you first need to understand the concept of relevant cash flow or relevant costs. All right. Now, guys, the reason why I would have to teach you this relevant costs before I move on to the payback period, adjusted payback period or the discounted cash flow techniques is because in the discounted cash flow technique, I'm going to teach you adjusted payback period, IRR, and also NPV. Now, you need to remember that all three of these, it uses the concept of cash flows. So what I want you to be very, very clear about is that as and when we do each topic, there will be a prerequisite that you would need to know. So I would have to go through in very simple and quick, very, very quickly, what is relevant cash flow and how this would affect your calculation. All right, now, the reason why I need to do relevant cash flow is because all these three that I just told you, they use the concept of cash flow. And besides using the concept of cash flow, it also requires you to have knowledge on relevant costs, because when you have the knowledge on relevant costs, you will be able to answer the question in a more effective and efficient manner, because then identifying the cost components will not actually take that long anymore. Okay, so what I want you to be aware of when we are doing the questions here, number one, I'm going to give you an example on relevant costs, and as a result of that relevant cost, you will also need to know how will a company make the decision when it comes to relevant costs. All right, so let's start with understanding first the concept of relevant costs. So I just want to remind you that this is not in my notes, so we would have to write a little bit. Don't worry, it's very simple, it's very straightforward. And as and when I write it, I'm sure that you guys will have no problem or no issue to understand the concept of relevant costs. Again, in case any one of you have already taken the performance measurement paper, performance PM paper, okay, previously it was called as F5. There you would have learned extensively about relevant costs, and to be very frank and honest to you, that would really help with our relevant costs here that we are going to do in our FM paper. But don't worry, since I'm going to guide you very, very closely, I hope that you would be able to understand relevant costs better. Okay. Sorry guys, I'm just going to stop sharing for a while. Just give me a moment because I shared the wrong page actually. Yeah, okay, so one moment. Okay, so for the purpose of our relevant cost exercise, I'm going to use the example or the lecture notes from BPP. So I hope that you guys, if you have the PPP book, you would also be able to answer the question together with me. All right, now share screen. Okay, so what is the concept of relevant costs? Okay, the concept of relevant cost is, okay, number one, relevant costs. Okay, whenever you talk about relevant costs, you first need to understand what does it mean by relevant costs, right? So from your previous lessons, you would have known that relevant cost is a cost or a cash flow that arises as a result of a decision that you have taken. So this relevant cost is incidental to the decision undertaken by a company. Okay. In other words, to make it simpler for you, what is a relevant cost? A relevant cost is a cost that is relevant to the decision that you make, i.e., it only arises as a result of undertaking a certain decision. All right. So here, it arises as a result of undertaking a certain decision. So what does it mean? Okay, example, let's say your company wants to purchase a machinery. Let's say you just want to buy certain machinery, and as a result of buying this machinery, what happens is that you need to incur machine running costs. So that machine running cost is a cost that is incidental to the decision of buying the asset, the machinery. All right. So just to remind you, this is a relevant cost because number one, it is incremental cost. When I say incremental means it's an additional cost that you need to incur as a result of undertaking the decision to buy the asset, the machinery. Okay, so what are the components of relevant costs? So I always tell my students, remember only one version of it, the other is the opposite. So let's talk about relevant first. Okay, when you talk about the relevant cost, number one, a relevant cost is a future cost, sorry. It has to be an incremental cost. And it also has to be a cash flow. Finally, it has to be a specific cost. Okay. A non-relevant cost, on the other hand, okay, since you already know what is relevant, right? Now the opposite. Non-relevant cost is a sunk cost. Okay, so if relevant is a future, non-relevant is a historical cost or a sunk cost. The opposite of incremental is committed. I will explain it in a bit. Cash flow is non-cash item. And here, the opposite of specific is general allocated cost. Okay. Now, what is an example of a future cost? That means you are due to incur it in future because you take on the decision. Example, all your variable costs. Okay, all those variable costs are costs that you are due to incur in future because you have undertaken the decision to buy the machinery. Now, a sunk cost is a cost that has already been incurred. Okay, a sunk cost, a cost that has already been incurred. Or another word you can use is historical cost. All right. Incremental cost is additional cost that you need to incur. Example, additional fixed cost, additional variable cost, any extra cost that you need to incur. Okay, let's say your company has already been incurring a maintenance cost, but as a result of undertaking this decision, you have an additional maintenance cost. So that additional maintenance cost will be the relevant cost. Now, a committed cost is a cost that you have already agreed to incur for a duration, for a specific duration or for a certain amount of time. Example, a committed cost is what you call that? Rental. Okay. Why? Because you enter into a rental agreement today, you have signed the contract that you will have to pay rental of, let's say, $1,500 for the next 1 year. But you must remember, whether or not you use that property, you need to pay rental because you have committed to incur this cost, to pay this amount. So it's not because of a decision, it's a contractual agreement. It's a result of a contractual agreement. So here, a result of a contractual agreement. Okay, contractual agreement. A result of the contractual agreement. Example, rental. Committed to incur for a specified duration. All right. Now, cash flow and non-cash item. Okay, you know what a cash flow is? A non-cash item are items that don't actually lead to the company having a payment or a receipt. Example, depreciation. Depreciation is just an amount that you have calculated, you have estimated, you will reduce from the value of your non-current asset. That means you estimate that you will reduce the value of the asset by 20% a year. And as a result of that, you don't actually have a cash outflow, but the value of your machine or your whatever non-current asset is going to reduce. Another example is amortization. Sorry guys. Amortization. Okay. And the final one is your specific cost. Specific means you have to specifically incur this cost as a result of your decision. The non-relevant portion is a general or allocated cost. Example, your general fixed cost. Whether or not you have the decision, you need to pay this cost. So it's not incidental to the decision, but you have to incur it. An allocated cost example, let's say your head office, you have a overheads of $120,000. Now, in order to make or to allocate it appropriately to see how much each division incurs, you will allocate the cost to individual division. So that is an allocated cost, all right? So costs that are allocated from HQ. So this is normally overheads. I don't know whether you guys remember or not, but remember when you learn your CAT level paper, you had one of the topic where you learn about overhead allocation, right? This is one example of the costs that are allocated, and it's a general cost. It's not incurred specifically due to the decision that you undertake. All right. Now, so with this, I'm hoping that you understand very, very clearly about relevant costs. What else do you need to know when it comes to cash flows? Okay. Um, cash flows, you need to also know, okay, besides this relevant or non-relevant costs, you also need to know whether or not to include these costs, okay, as part of the calculation. So now, if you look at the cost elements that I given to you, example, he give you a range, a list of costs. So from that list of costs, I need you to be able to clearly identify whether or not there is a relevant cost, because if the cost is relevant, you need to include it in your calculation. If it's not relevant, you have to exclude it. So normally these are the little things that your examples that your examiner will include. Okay, you just need to be a bit more careful, because sometimes he might use very confusing terms. Okay, when he uses confusing terms, you just need to be a bit more careful, that you are able to identify all the costs appropriately. Now, I just want to remind you another type of cost that can be considered relevant. This falls under the category of specific costs. Okay, it's not just specific costs, it's also opportunity costs. Can anyone tell me why do I say that opportunity cost is also a form of a relevant cost? Okay, maybe I can give you about 30 seconds to 1 minute to think about it. Okay, if you don't already know what is opportunity cost, opportunity cost is a cost that arises as a result of taking on the next best option. That means you already have one good option given to you, but because you did not choose that, you chose the next best option. So you had to incur or you had to lose contribution. Let's say now you have project one. Project one, the contribution per unit is $30. And now you want to take up project two. Project two, your contribution per unit is $25. Okay. Per unit is $25. So what is an opportunity cost? Okay, let me just expand on the scenario a little bit. So now he says that if you take on project two, you cannot take on project one because you don't have enough resources. Let's say he says that. Okay, so what is the opportunity cost that the company will have to incur as a result of taking on project two? The opportunity cost that you have to incur as a result of project two is $30 per unit of contribution from project one. That means you lose $30 per unit from project one, but you gain $25 per unit from project two. So as a result of your decision to take on project two, you are losing contribution from project one of $30 per unit. Okay, so this is your contribution loss, and this is also the cost that you need to incur as a result of taking the next best option. Okay, so I hope you're very clear about opportunity costs. Okay, but you must be able to very clearly define or understand opportunity cost. Another way where I can explain opportunity cost for you is that opportunity cost is also defined as the cost that you would need to incur, okay, when you are letting go of an option. That means you let go of something, you gain a certain amount of You let go of one cost, you gain a certain amount of profit, but the one that you let go, the benefit that you have foregone from your previous project is what you call a opportunity cost. So there are so many methods or so many definitions that we can put for opportunity cost. I'm just going to write a few here. Foregone, um, benefit foregone, uh, just now I said the cost, the cost or letting or taking on the next best option. Okay, so this is what you mean by an opportunity cost. So now with this, I actually want to try to do a few questions with you, okay, relevant to questions relevant to relevant costs. Okay, so let's try. I'm going to start off with the first question, which is the example from your BPP course notes. Okay, okay. So this, oh sorry, let me just reshare my screen so that you guys can see. Okay, so this is extracted from the BPP course notes. Now, I also want to try later on, okay, later on, not now, okay, after I finish this question, I want to try to do another question with you so that we have very, very clear understanding of what is relevant costs, okay, and what is relevant cash flows. All right, so let's start with doing this first. Let's read the requirement, okay. So, assess the relevant cash flows of the project in the first year to Brenda and Eddie. Ignore the initial setup cost of the project and advise Brenda and Eddie whether they are right to be concerned. So guys, I just want to quickly give you a reminder. Whenever the examiner asks you to advise, you must remember this advice, whether you are saying yes or no, accept, reject, whether you are saying take on the project, do not take on the project, all these will actually cost you 1 mark. So whatever happens, whether or not you are sure about your your final answer, please do not forget, please do not forget to write or advise them appropriately, because if you don't advise them appropriately, you're going to lose your marks, 1 mark. That 1 mark is actually the difference between your 49 to your 50, which is vital. It's very important. Okay, so please remember to always, whenever he asks you to do it, do it. All right, now let's go into assessing your cash flows now. So Brenda and Eddie have further analyzed profit made in the first year and are concerned that the project would be loss making. So this is their problem. They are worried that their project is going to be loss making. Their year one cost and revenue forecasts are as follows. So he has revenue, depreciation, material, labor, overheads, and after that he calculated his profit and loss. Now, let's read each and every note, and from there we identify whether the cost that has been included in the profit or loss calculation is relevant or not. Now, the materials include 10,000 pounds of surplus inventory. So, 10,000 pounds of surplus inventory that Brenda and Eddie have in their existing restaurants. That means now what you are doing is you are starting on a new restaurant, but you already have other restaurants in your that are already currently operating, that are existing. All right. So what you are doing now is you are trying to identify which of this material cost is relevant and not. Okay. This 10,000 pounds of inventory is something that is already there. Okay, so as a result of it being already there, you need to understand that this one, you have bought it like a long time ago and it's just sitting in your inventory. That means this 10,000 pounds is actually a sunk cost because you bought it long time ago, historical cost, sunk cost. So is 10,000 pounds relevant or not? It is not relevant. Why? Because it is a sunk cost. Now, so because it is not relevant, what I want you to do is you minus this 10,000 because he included this cost inside the 49,000, but it's not relevant. So you exclude it. All right. Now, this inventory has a scrap value of 1,000 pounds. Okay. Remember I told you future cost is a relevant cost. Scrap value is a cost that you will have to incur or you will obtain when you sell your inventory in future. So it's a future cost. You will only include it in your calculation because it's future and it is relevant. So scrap value is a relevant cost. Okay, it's a relevant cost. So you have to include it as part of your material cost, right? That means in future, when you want to sell the inventories, these inventories value are now only 1,000 pounds, right? So actually, what you are doing is you are removing out the historical or the sunk cost and you are replacing it with your future cost, which is the scrap value of 1,000 pounds. That becomes relevant. All right. Now, the next one, note number 2, labor cost. Okay. Labor includes 20% of the 50,000 pounds salary of a manager of an existing branch who will assist the existing manager of the restaurant in the first year of its operations. That means you have already a manager that is helping running your business, right? You already have someone who is helping to run your business. And you hire a new manager for the branch. So that is one additional cost that you need to incur. Okay, so your labor, since you already have someone that you hired for the current operations, okay, and at the same time, you already have in your existing restaurants, okay, this value of your manager's salary, that means he included 20% of 50,000. So 20% multiply 50,000 is 10,000. All right. So this amount, this 10,000 has been included. Now, my question to you is whether or not this is relevant. It is relevant because, it is not relevant because this manager's salary has already been committed. That means you pay the salary, you sign a contract with your manager. So when you sign the contract with your manager, you are allowing or you are paying him on a contractual basis. So whether or not he does his work, you need to pay him. So this manager's salary becomes not relevant as he is not a result of your decision of the new restaurant. You already hired him like long time ago, right? So this 10,000, you have to exclude it from here. And finally, this is note number 3. This is an allocation of corporate costs. Remember, I told you any cost that is allocated is actually a general cost. And because it is a general cost, it becomes not relevant. So you remove it altogether. So what you need to do is you need to redo your profit statement. Okay, guys, please redo it in a proper place. Revenue, relevant. Your depreciation, relevant or not relevant? Okay, not relevant. Why? Because not relevant because it's a non-cash item. So nil here. Materials, okay. 40,000. Guys, remember this is a cost. Here 90,000. Here negative. Now, I think it is 70,000. Is that okay? Okay. So please remember, whenever when you are identifying whether or not it is relevant or not relevant, please be very sure for you to know why it is relevant or not. That means you must know how to explain relevant, why, not relevant, why. So if you want to say why, you can use the four concept: future, incremental, cash flow, and also specific. These are the explanations that you can use, okay, to explain whether it's relevant or not. Now, let's try another relevant and non-relevant cost type question. Look at your investment appraisal lecture examples, okay? You will find relevant cash flow criteria, illustration number 2. Yeah. So, look at the example here. State whether each of the following items are relevant cash flows. Explain your answer. So this is where I'm going to test your knowledge, whether or not you are extremely clear about the classification of relevant and non-relevant costs. Now, he asks you to explain regarding the feasibility study, rental, the cost of the equipment, depreciation, and the salary of your managers. So let's go up and read each scenario and try to identify whether or not this cost is relevant. So here, a business is considering investing in a new project. They have already spent $20,000 on feasibility study, which suggests that the project would be profitable. Okay, now, is this relevant or not relevant, and why? Okay. Already spent means it is a sunk cost or it is a historical cost. The moment it is this, it becomes non-relevant. The headquarters of the company, so this cost is not relevant, guys, okay? So the feasibility study is not relevant. The reason is because it's a sunk cost or a historical cost. The headquarters of the company has a spare floor space which will be allocated to the project, with 7,000 of the current monthly rent being allocated to the project. Now, the moment this is an allocated cost, whether or not you have the project, you have to pay the rent. So it becomes non-relevant because it's a general or it's a allocated cost. So rental is not relevant because it is a general or an allocated cost. Okay. Next, a new equipment costing 2.5 million would have to be brought and depreciated on a straight line basis. Now, this cost is relevant because this is incidental to the decision that you are taking. This is an incremental cost. It becomes a relevant cost. Next, a manager who earns 30,000 per year currently runs a similar project will also manage the new project, taking up 25% of his time. So guys, I'm not sure whether we remember, but previously in the lecture example that we did, it is the exact same functions and conditions here. Example, you are already hired by your company, you are paid salary on a contractual basis. Now, even if you allocate 25% of your time, you will still be hired whether or not you take the new project. So this person's salary, it becomes non-relevant because this is actually a committed cost. All right. So if you want to explain your answer, how do you do the explanation? Okay, like this example. I'm just going to give you one or two examples. Okay. The cost of feasibility study is not relevant as it is a sunk cost and has already been incurred and not incidental to the decision. That means you didn't incur this cost, after you take on the decision, you incurred it before you took on the decision. All right, so this is how you need to explain. Okay, let's say the non-relevant cost, okay, depreciation of the new equipment is a non-relevant cost as it is a non-cash item. Okay, so these are the explanations that you need to give. So that's why I say, as long as you know my 4 items there and the opposites of it, it will be so easy for you to answer a relevant cost or a non-relevant cost type question. Okay, any questions so far? You can always look back at your lecture, ask them what is the reason, okay, for further clarification. But I think I've given sufficient clarification for you. I don't really think there would be something that you really need to ask, because I believe the explanation that I've given you is sufficient. Okay, now in the next part, okay, in the next video, I'm going to teach you about adjusted payback period, IRR, and net present value. Okay, so I will start from the basic NPV. I will move to the advanced NPV. Okay, so I'll see you guys in the next video.